the effect of FOMC on markets. We're going to talk a little bit about the projection, what the Fed actually does at the main rate decision timing for a given FOMC, and then also how the market tends to digest the press conference and the information, the votes that came out of the individual members, the outlook for inflation and geopolitical risk, how that can affect markets at large. But Katie, first up, the major effect of any FOMC event, of any Fed event, really is going to be on short-term rates, because that's what they move around, right? And maybe you can speak a little bit to what we're looking at here, which is almost 100% projection of a hike to rates. And thus, obviously, the first tier mover is going to be interest rates, right?
Yeah, exactly. And I think you pulled this from the FOMC FedWatch tool or something along those lines?
This is the CME FedWatch tool. If you just Google CME FedWatch, this is a great tool that I look at plenty of times, and I'm sure you look at plenty of times around the FOMC event.
Yeah, exactly. So as Frank alluded to, the Fed can only really control short-term interest rates, but that doesn't mean we won't see kind of like a chain reaction effect for the rest of the various maturities on the yield curve. So here, as you can see, like you said, they're projecting to hike by 50 basis points or so. And I think the question that I always got confused on as a new trader to these types of products is, okay, knowing that information, is that already baked into the price of S2Y, or is this something where I should be buying it like right now in the next 40 minutes before the announcement and like immediately profit if S2Y goes up?
It's a great question, and it's something that I really applaud. See, this is how great Katie is as just a human being, as a personality, because she knows the answer. All right. And she's been knowing the answer probably since before I showed up in this industry, but she just lofted a softball.
You calling me old?
Across.
I'm kidding.
Frank's getting in trouble. Even when he's trying to compliment, he ends up getting in trouble. But Katie, it's a great question that almost everybody encounters when they're just getting started in actively trading, and they're just coming upon, what does this Fed do? What is this FOMC? So if there's 100% chance that they're going to hike today at 1 p.m. Central, 2 p.m. Eastern, then I could just buy all the interest rates, and then boom, right at that time, I'm up a bunch of money, baby.
Print
That's
money.
Great. Yeah, it's really nice. But I do, unfortunately, I know it's cliche to use like a sports analogy or whatever, but I think it's pretty apt, where it's like, if you're watching a basketball, like for instance, last night, the Celtics beat the hell out of the Bucks.
My boyfriend was not happy.
Oh, big Milwaukee guy, huh?
Yeah, Bucks boy.
Look at that. Okay. Well, Katie, I just built her up. I'm like, she's the absolute best. She lofts this softball question across the plate. Then she has to sneak in, my boyfriend. We know you got a dude. Okay, Katie. Jeez, you got to brag about it. But anyways, the Celtics are beating the Bucks, right? They're up by almost instantly. They're up by 20 points.
Yeah.
Let's say it's the fourth quarter with a minute left and they're up by 25 points, and the likelihood of them winning is 99%. And you go to the betting market and it's like, ooh, I get to buy the Celtics. It's 100% chance that I win. And your odds are, minus 10,000. Like, you're going to have to lay $10,000 to win a dollar, $100 or whatever. Similar here, where like this market's been rallying. Like the interest rate market has been rallying, been moving higher. It's all priced in. And in fact, it's like a classic chicken and egg situation where it's actually not that, because the projections that we get come from the futures prices. And so the projections don't even necessarily move the prices. These prices are where those projections come from. And so there's nothing to make of that, Katie, where it's like, ooh, I can make a bunch of money on them actually hiking. They're going to hike in a little bit from now. The real trade is if they do end up hiking less, which is unlikely, they'll probably hike exactly as much as projected, or if they talk down future rate hikes, which we do tend to see, right? Like we'll see them do what is projected, but then they end up saying, oh, we're going to hike less than expected, or we're going to hike more than expected. That's where you could see interest rate products like the S2Y fall if they talk down those rate hikes, or rise on the vice versa here if they talk up. Look at that, right? In real time.
I love you. I'm working on the fly.
If they talk up those future rate hikes, Katie, you'll see that market rise. And that's really where the trade is in interest rates, the most direct effect from FOMC, right?
Exactly. Yeah, I think you laid this out so perfectly, because there's all these, I mean, treasuries as a whole were so confusing to start because of the nomenclature and the way that they're set up in terms of their contract specs. And then there's all this extra jargon like 30 seconds and, quarter ticks and hawkish and dovish. But just like the way that you've laid it out today, where you're defining it as you go in a very digestible product. S2Y is what, like $200 in buying power or something?
Exactly.
It's such an easier step than it was even 5 years ago.
Exactly right. And I'm glad that conceptually we can lay bare the effect of something like this on interest rates. And then also in practice, you have small products that directly translate as well, where it's like, if they were to come out today and, let's say they end up only hiking by 25 basis points, this little, 0.7% chance here, they end up hiking by less than expected. You would expect this market here to fall by about 25 basis points, which would be $2.50 in the futures price. So it's really direct in its translation. If you think rates could be talked down for the future or talked up for the future, whether or not you're going to respectively sell or buy. The big question after that, because there's going to be great trading in interest rates for the 2-year, the 10-year, and the 30-year. I've got some short 2s, long 10s, and long 30s going into it. And I'm looking to scalp around that if they get outside their standard deviation. If S2Y is up or down $1 or more, I'm probably going to take the other side. What's usually even better of a scalp is the less direct effect of the FOMC on markets like stocks, like foreign exchange, like metals, or other commodities like crude oil, Katie, because the correlation isn't very tight there. It's essentially asking the effect of FOMC on these markets is how correlated are interest rates to the rest of these markets. And to stocks, they're moderately, correlated. To metals, a little bit less so probably, and to foreign exchange, very little here. And so that could make for some good fades. And maybe you can speak to, second tier markets and what we might mean by a good fade coming off of an event like an FOMC.
Yeah, exactly. So I love this chart that you added too, because you broke it down into a couple of other small products that are, I think less than $600, $800 in buying power, and even smaller on the smaller end of this range. So 3 markets, as you said, that could possibly be moving. Equities, of course, we will most likely be seeing moving, as well as the foreign exchange markets, and SPRE. SPRE has been on my radar. I should have mentioned that at the top of the hour, but the gold and silver space has been really interesting, and kind of silver getting, hammered, and gold just kind of floating at this one level for the last couple of days. So of course you can consider doing something where maybe you are fading SFX, or maybe you're looking to nibble long or short, depending on what your directional assumption is. Who am I to tell you on STIX or SPRE? But these are, 3 easy areas that you can kind of also observe or add to your watch list at this 1 o'clock, 1:30 time frame. So in the next hour or so, that we might see a little bit of movement, and therefore, like you said, moving farther out of those typical deviations in price to capitalize on these extremes.
Yeah, and these are great fades, like we say, because the effect of the FOMC is just less direct, right? Like interest rates, if they come out and they're like, we're hiking like crazy, interest rates are going to go higher, and these markets are all going to move around, but there's a good chance for them to kind of come back to about where they were, because as they digest it, it's like, oh, maybe it actually, it's more higher rates, for instance, would mean probably some downside in stocks, But then maybe that stock market comes back a little bit as people are like, well, actually, the stock market's made up of individual stocks that maybe some of them are outperforming. Just the effect is less direct in there. And so that's why we might look at fading. And so what's really nice as we enter this FOMC here today, Katie, everything pretty much around unchanged. And so if we do see any, big moves in this market, I'm pretty much just monitoring the net changes relative to the standard deviation. So if we get, more than $1 move in sticks, I'm probably going to look at buying or selling that market. Same goes for crude oil, already outside of that standard deviation, but especially as we get in here, like Katie noted, metals moving around. If we see a move in spree outside of $1 or SFX outside of 60 or 70 cents, I'm going to probably look to fade those moves because that effect of the FOMC is less direct. Any last notes for you on, how you might be trading this event that's coming up in the next hour?
I think the one thing to remember is that you're going to see a knee-jerk reaction, like right as this happens. So in an ideal world, everybody would be able to carve out time on their calendar and just sit and watch their platform. It doesn't mean that you're necessarily going to fully miss the opportunity if you don't buy sell the top or paint the bottom or whatever it might be. But just keep in mind that this might not have a super long-term lasting effect into maybe even next week. So you've got to really kind of think about these as shorter term plays and not try to get too greedy in here. I would stick to probably looking at these as 1 or 2 day plays at the very most.
Exactly. I think you're exactly right. 24 to 48 hours worth of trade. And we have a non-farm on Friday, which is actually also nice as to if you have a position, say for instance, today, the US dollar spikes $1, I get short and I'm looking, like Katie says, for a 1 to 2 day trade. If I don't get that move probably by Friday afternoon, by Friday's non-farm, I'm probably looking at managing it or defending it because you don't want to start making core decisions off what should hopefully be some great short-term trading off of the FOMC. Katie, that's it. That's all we got, my friend. Any last words for you? Hopefully your Bucks boyfriend is doing better in the near future here, but we love having you on. Are you now a Bucks fan?
No, I'm still a Bulls fan. We are a house divided, but either way, happy synthetic Super Bowl interest rate Wednesday to you. May the odds be in your favor. Any other cliche you want to throw in there?
I like that. Let's leave with that. Everybody have a great FOMC here today. Make sure you're jumping on the activity. Make sure you're doing it small and you've got your in and out markers and everything else. And may the odds be with you. And may you also stick around for Splash into Futures coming up next. I'm sure they're going to have plenty of FOMC stuff to talk about. Have a great day of trading, everybody. Peace.